Information contained herein is for informational purposes only and should not be construed as an offer, solicitation, or recommendation to buy or sell securities or personalized investment, tax, or legal advice. Information has been obtained from sources believed to be reliable. However, no guarantee is made or implied with respect to its accuracy, timeliness, or completeness. Hi, everyone. Thanks for taking the time to join us to learn a few things about investor psychology and behavioral finance. When it comes to investing, most of us immediately think of different investments we can pick. We'll ask ourselves, which stocks will make the most money this year? What could I invest in that will reduce my taxes? Essentially, what we want to know, what portfolio do I need to create to reach my goals? But investment success doesn't necessarily begin with our portfolio. Even the ideal perfect investment strategy will fail if its owner keeps making changes to it. Jumping in and out of assets is quite common. Investor behavior in 2020, 2021, 2022 was especially impactful to the bottom line. Whether it was the fear in the markets beginning with the COVID crisis, or hesitation to get back into the markets when it rallied, or now most recently, various wars, inflation, and interest rate risks going on. The main message today is this: the way you behave as an investor can often have a big impact on your financial future. Today, we're going to walk through some of the common mistakes that investors can make when they mix their emotions with their decision making and how to prevent them. The foundation of investing is based on investor behavior. We got 4 charts here. If you could choose only one, which one would it be? The orange one, the pink one, the green one, or the yellow one? Take your time. Let's look at some of the chart patterns to see which one you might choose. All right, so the orange one represents Pfizer. The green one is the S&P 500. The yellow one represents U.S. Treasury bills, and the pink one represents Fairfield Century. Most people haven't really heard of Fairfield Century, but most people do remember Bernie Madoff. Fairfield Century was the feeder fund to Bernie Madoff's investment firm. The one investment on this chart that went up seemingly no risk turned out to be the one with the biggest fraud in U.S. history. History has shown there are no magic bullets when investing. Investing involves risks, and as human beings, it can be tough to manage your emotions when markets go up or down. Today's presentation is how to recognize your emotions, explain why those emotions can affect your money, and how to work with your financial advisor to put you in the best position to meet your financial goals. Investing isn't always about being smart. Here's a story that illustrates what I mean. Isaac Newton is considered one of the most important scientists in history. Even Albert Einstein said that Isaac Newton was the smartest person that ever lived. Newton developed the theory of gravity, the laws of motion, basics for physics, new math calculus, and made breakthroughs in developing the modern telescope. In 1720, way before Madoff and way before Bitcoin and crypto, Sir Isaac Newton lost 20,000 pounds, or more than 3 million in today's standard of money, by investing in the South Sea Company. So, had he actually earned 7,000, close to 1 million from the same stock a few months earlier. But he bought it back in after the stock skyrocketed, thinking he was missing out, eventually leading to his tremendous losses. Newton then concluded he could calculate the motions of the heavenly bodies, but not the madnesses of the crowds. When it comes to investing, it's important to try our best to separate our emotions from our decision making. as hard as that may be or sound, when external factors around us are rough, it can enhance the fear of loss that we naturally have with our investments internally. We're constantly being bombarded by media more now than ever, which doesn't help with different emotional feelings about the financial future. The big takeaway here is Warren Buffett said, we don't have to be smarter than the rest, we have to be more disciplined than the rest. We're going to talk about the psychology of investing. That's our agenda today. And how to build that discipline. By understanding the psychological factors of behavioral finance, we can better understand why investors often make buy or sell decisions that contradict investment best practices or rational investing. More importantly, by understanding the common investor behaviors that lead us astray, we can learn how to recognize and avoid these tendencies. Envy, the fear of missing out or regret of what might have been. And loss, losing money. Losses feel twice as bad as gains, which is very common in investing, and challenges that prevent average investors from becoming ideal investors. This presentation will illustrate these common behavioral biases and show you how to implement discipline strategies for you to use with or without your financial advisor to inspire a smoother, more disciplined approach to investing. We'll start with envy. Envy is that emotion that gets us thinking, what if? Also known as FOMO, the fear of missing out. The fact that most people regret what could have been can be very damaging if that starts to take over their emotions, affecting their thoughts about their investment plan. Rational people regret only bad final outcomes, but most people regret what could have been. I should have, would have, could have theory. For example, a study looked at Olympic medal winners and found that bronze medal winners were happier than silver medal winners. Why? A silver medalist likely thinks about how close they were to reaching the gold. A bronze medalist, though, might imagine how close they were to not receiving any medal at all. Depending on the alternative, a person feels either relief or regret. While relief is a positive emotion, regret can be a painful and bitter experience. While you might not stand on a podium anytime soon, the reactions of the medal winners give insight into a universal truth. Happiness is relative. In an ideal world, we need to imagine the regret we would feel if we had an emergency but didn't have the savings to cover it. But that can be hard to do. We probably have seen this recently with unexpected deaths and crowdfunding campaigns to pay for expenses. Planning is very important. Sometimes planning for others is even more important. S&P envy. We saw a lot of regret coming into the start of the year during 11-year bull market with investors when they looked at their portfolio versus US stocks. We call this S&P envy. And it's easy to see how this S&P envy comes about. And it's more than just the last 11 years. It's the inability for investors to connect the dots of investment returns over various market cycles. In a bear market, a diversified portfolio still loses money. That never feels good. Then in a bull market, rebounds and you trail the index. This chart right here shows it. The left are the years, the middle is the S&P 500, and to the right of it is a diversified portfolio. And you'll see orange and pink where in between those years, people lost money. And then the envy, the pink, I didn't make as much. But you'll notice in the very bottom, this is the total return. The S&P 500 did 268%. Diversified portfolio did 275% return. So you can see where this S&P envy comes from. Diversified portfolio never feels like it's winning. lose money, trail the market, lose money, trail the market. A diversified portfolio is difficult to own. It never feels like you are ahead, often leading to a feeling of regret. We start to wonder to ourselves, why am I losing money? I thought my portfolio was diversified. Or why does my portfolio always underperform? I'm leaving too much money on the table. But the punchline is if you add up all these periods, diversified portfolio actually works out even when it feels like it's losing. Also, the volatility is much less. It's very much less. This kind of regret and not understanding why we build portfolios the way we do can lead to bad investment decisions. Another example of envy, most people will tell you that buying a lottery ticket is a poor plan for financial success. But why are we willing to play even when we know the odds aren't in our favor? We are often willing to accept a high probability of poor returns for a small chance of earning large returns. This is often called the lottery effect. This is also why investors are willing to concentrate positions in single issue stocks or invest in the next hot startup. The excitement of large returns clouds our better judgment, and we make decisions that reduce our overall chances of success. When we run into serious risks when we get caught up in the lottery ticket effect, if you come to the S&P envy and started stock picking individual stocks, there was roughly a 1 in 3 chance for each stock you picked to have lost money from 2016 to 2020. Whereas if you invested in a basket of securities like a mutual fund and ETF, only 0.2% of those funds lost money over the same 5-year time period. These two circles right here show it. The US mutual fund ETF won quite often. And as it turns out, limiting losses, especially big losses, is a true key to investing success. Warren Buffett has said that the first rule of investing is not to lose money. And that rule, number 2, is to not forget rule number 1. It's all about the math. If you start with $1, lose half, 50%, you are left with 50 cents. What do you have to be up the next year to break even? You need to double it or be up 100% to get back to break even. This chart kind of shows the various different drawdowns. 10% drawdown, you need 11% to break even. And then when you go further over 50%, you need 100%. If you're down 60%, you need 150%. With individual securities or lack of this risk management, it's very possible to see a large drop in value, but it's much less likely in a diversified portfolio. When you give into envy, the results can make you lose sight of this important fact or your ultimate financial goal. If you're not suffering from envy, good job. You're probably constantly trying to minimize your losses. But on the other side of the spectrum, people will do irrational things to avoid losing things. This is where we run into loss. The overwhelming fear of losing your money can be just as harmful as not fearing it enough. Sometimes it can feel even worse. In fact, studies have shown that the pain of losing is twice as strong as the joy of winning. When things are already looking rough, it can enhance the fear of losing that we naturally already have with our investments. If we give into it, we may start to wonder what the worst case scenario may look like. All of us have a natural tendency to take action and try to fix our problems, to take control rather than do nothing. But taking action in these times isn't always the best solution. To draw an analogy, imagine yourself as a goalkeeper in soccer. Studies have shown that statistically, you are more likely to stop a penalty kick by staying in the middle. Basically, do nothing. But that's not to say you should always stand in the middle. But we are often emotionally geared to fix or do something when we are feeling anxious. This is what behavioralists call action bias, or thinking that value can only be realized through action, or to the tendency to act as opposed to practicing restraint. This was especially critical at the market lows in 2020. Investors who were focused on their goals and less about what the market was doing likely did better than those who acted out of fear. Taking action or trying to fix your investment portfolio often leads to trying to time the market. Missing just 5 of the best performing days of the last 20 years could have cost your portfolio more than $100,000, nearly a third of its potential value. And if you're unfortunate enough to miss the 25 best days, you'd have less money than you started with. A reality to consider is that 24 out of the 25 best days in the market came within 1 month of one of the 25 worst days in the market. So overreact to any one bad day and you can miss out. So the story here is don't let your fear of loss drive your investment decisions. Since we can't predict when the best days will be, staying invested is often the best strategy. It's all about the time in the market, not about timing the market. On the other side of this, when people get fearful with their investments, they tend to pull out of the market completely, moving to cash. These sideline sitters might say, I don't want to make any change right now. My stocks have done so well, or with the markets hitting new highs or all-time highs, I missed it and will wait for a better time. And we even see that right now. The markets have been correcting, and then people are like, oh, let me just wait. It's going to be the end of the world. And last year, markets were all-time highs, and the people are like, oh, the market's too high. I'm just going to wait. And then now in the present, they're still waiting. And you got opportunities going on right now, and then they're, oh, it's end of the world. I got to wait again. But there is no best time to invest unless you're a fortune teller or Nostradamus. Instead, it's important to get invested sooner than later in order to take advantage of the power of compounding gains. In this hypothetical example, where your money grows 10% each year, the difference between investing for 10 years versus 5 years is just 100% more. It would be 261% more, almost 3 times as much. Albert Einstein once said that compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. It may seem counterintuitive, but it can be helpful sometimes to take a contrarian approach. As Warren Buffett famously put it, be fearful when others are greedy, be greedy when others are fearful. This was especially true before and after the financial crisis. Investors lost as they rode the highs of the market in 2007, pulled out of the markets during the depths of the crisis and uncertainty of bank runs, but potentially missed out on historic bull market runs. And during that time frame, it was very rapid. When Lehman Brothers went down, the markets dropped super fast. And within 3 months, those markets were bouncing really fast. So it's easy to lose ourselves in our emotions. If we go one way and get too aggressive and risk taking, we can really harm ourselves. At the same time, it's just as easy and just as harmful to be too conservative. That just leaves a very narrow, disciplined middle ground for us to navigate in. So let's explore why it's so important to be disciplined and what we can do to get there. Experts typically suggest that when you're trying to break a bad habit, it's extremely helpful to tell someone else so that they hold you accountable. They can keep you disciplined and on schedule when you may feel like deviating. This is very common with any goal in your life. Tell people, and now you have some accountability to achieve your goal. When it comes to investing, the perfect person for that job is a financial professional with a non biased approach. Many people think of financial professionals as money managers, people who can make you money work as well as possible for you. That's true. But just as importantly, they act as an intermediary, a stopgap between you, your investments, and your emotions. In reality, financial professionals' primary job is to not worry about your portfolio, but to guide you through the wealth building process by helping you avoid common mistakes and keeping you on your financial path. Working with an advisor can help you make the emotional roller coaster ride of the market smoother and less volatile internally. That's the power of preparation at work. Talk to them about creating an investment strategy plan, a plan that will help dictate your investment strategy regardless of external forces, such as wars, inflation, and interest rates. That way, when your emotions start to influence you, there are guidelines that can be followed to stop any impulsive actions. Ben Graham, considered the father of value investing and mentor to Warren Buffett, said, "For indeed, the investor's chief problem and even his worst enemy is likely to be himself." As we mentioned, no one can predict what will happen next in the markets, not even experts on Wall Street and TV. And in a survey, only 43% correctly predicted whether interest rates would go up or down, less than a chance of getting heads from a coin flip. We can't control the future, only ourselves and how prepared we are to face it. So turn off the TV, or at least don't overweigh what news sources are telling you. As Yogi Bear once said, it's tough to make predictions, especially about the future. So to recap, recognize those common mistakes and tendencies to repeat them. Be willing to be critical even when times are good and opportunistic when times are bad. Invest for the long term. Don't try to time the market. Work with your financial professional, keep you in check, and ensure you're reacting to the market rationally. Create an investment strategy plan that outlines how much loss you are willing to take and what conditions should be met in order to make buy or sell decisions. Work with your financial advisor to keep you in check and ensure you are reacting as rationally as possible. To sum it up, in the end, how we behave has a huge impact on your portfolio's behavior. And oftentimes, the more we try to step in, the worse we can make it. Work to mitigate the impact your emotions have on your investments so that you can save them for when they really matter with the people that mean the most to you. And if recent events have reminded us of anything, it's how truly important our friends and family members are. Thanks a lot for attending. I hope you learned some things about the psychological aspects of behavioral finance. Thank you.